Hello and welcome to Market Domination. I'm Julie Hyman, Jared Blickery in for Josh Lipton today, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz getting you up to speed 1 hour before the closing bell rings on Wall Street.
We'll see if this momentum, longer-term momentum continues, but we expect more of a average year for stocks. The 20+% returns is not in our forecast. We just went out with our outlook earlier this month, called it pragmatic optimism, and we think that really sets the tone for 2025.
I think one or two rate cuts for next year is sort of a base case. But the market and the Fed are going to be highly data dependent. The Fed has said that all along. And if the data starts showing a bit of a different narrative, if inflation is not moving lower as they'd hoped, I think we have to look at maybe a pause or a continued pause in 2025.
What will exactly those new economic policies be around trade, immigration, fiscal policy, and regulatory policy? How will those things shape up? None of us really know right now, and we do anticipate that that uncertainty will weigh on activity to some extent, and that will help push bond yields a bit lower over the course of the coming year.
We got 1 hour to go until the market close, and we're taking a look at the major averages, Jared, and seeing after a little attempt this morning at a rally, didn't make it.
You know, I'm thinking about the Santa Claus rally because this is the fifth day of it. It actually extends 2 days into the new year, but if it's negative, it portends negative returns for the entire year with above average results there. So historically, it does mean something that we're experiencing some weakness right here. And those two back-to-back 1% down days, I think, is even more instructive.
Yeah, exactly. Now we've got 4 days overall that we're seeing this decline. The first streak like that we've had since September. So looking at the 10-year there, but let's quickly just look at the Dow over the course of the session, because you see that sort of attempt that failed for the Dow, for the S&P, which is down about 0.4% now, and for the Nasdaq as well, down about 0.7%. Interestingly, the equal weight is outperforming today.
You know, it's a yin and yang here. And there's been a lot of talk about the outperformance of equities this year and why bonds had to catch up. And maybe it's just technical selling to rebalance portfolios because there's so much passive investments. So take this as you will. But I'm going to be laser focused on not just the two first days of January, but the whole month, because that's really more instructive here. And we're going to get a new president in there as well.
Yes.
So
you
we're going to learn a lot.
Santa Claus, rally or not, followed by the January effect. We have all these sort of market things that we watch over the course of time. I know that you've been watching what's been going on with the sectors very closely lately, and there's maybe a little bit of rotation that's been happening.
Let's take a look. Energy is leading today, so that's by far and away the outperformer. Tech is lagging, but if we take a look at the month to date, we're going to see a pretty negative picture for December. Only consumer discretionary, which is Amazon and Tesla mainly, is in the green here, but take a look at tech. That's just barely underwater, so the mega cap's not too bad, but materials, cyclicals taking it on the chin there. Energy, real estate, utilities, industrials, healthcare, financial staples, all of those down by more than 5%. And let's take a look at the year-to-date totals as well here, because you can see a very different picture. Materials in the red there, but communication services, that's Alphabet, that's Meta, that's number one. And then number two is financials. Number three is consumer discretionary. Number four, behind the S&P 500 itself, is tech. And that was by far and away the leader for the first few months of the year. So a bit of a reversal there.
Yeah, it's been an interesting trajectory over the course of the year, and especially since the election.
Let's do that
seeing
as well.
that big post-election surge, and then kind of, you've got an election board all ready to go. Look at you.
Last day of the year, we come prepared.
Yeah, so this is since the election.
Yes, and consumer discretionary is the big outperformer. That's up 10%, followed by communication services. Again, that's Meta and Alphabet, then financials, then tech. So there's kind of a theme here where we see Mag 7, we see mega caps leading, along with financials, and that's probably on the deregulation vibe right there. But tellingly, you know, the U.S. dollar, we haven't mentioned that yet. We're going to talk about this with guests. That is at a 2.5-year high, I believe. Materials is suffering as a result. That's down 10%, and other cyclicals as well.
And one quick caveat when we talk about all these election moves, even when you're talking about, let's just take the communication services as one example here.
Sure.
Do we have the election on here? So
There
here
you
it is
go.
since the election. That surge has been followed by this pullback that
Yes.
we've seen in December. So there is now this sort of, and we're going to talk, as you mentioned, with some guests about this phenomenon as well. What has driven this? We're going to talk to one guest later who says it's happened in sort of two phases, and that there are two reasons behind those phases. So we'll get to that.
Pins and needles here.
Yeah. All right, let's get to our first guest though, huh, Jared?
We bet. Investors set to wrap up 2024 with big gains despite weakness on Wall Street at the end of the year. Even today, we're seeing stocks lose steam heading into the close, but our next guest sees this weakness as a buying opportunity. Joining us now is Dory Wiley, Commerce Street Capital CEO and President. Dory, you were just listening to us talk about the market. Why don't you just give us your big picture 30,000-foot overview here of what's happened in 2024 and what you see for the next month?
Sure. Well, nice to be here, Jared. Thank you. And hello, Julie. And nice summation. I love the way you guys have those charts and stuff. They're so readily available. I need that screen at home. But I think what we're seeing here is a combination of what you kind of hinted at already. Some profit taking. Stocks are up 2 years in a row. There's some sector and portfolio rebalancing going on. Fear of rates, not coming down as much. You have Goldman Sachs forecasting 3 rate cuts and others more. And yet the Fed came out and said, we're moving our dot plot to 50 basis points, not 100. And then when you look at the curve is the 10-year, right, is up 60 basis points in the face of 100 basis points cut. So I think the prospects for the investor are like, you know what, we may not be cutting rates as much as we think. We've got inflation sticky at 3.3%. If we're going to have a rally, it needs to be on earnings. And the stock market has it. And the Q4 should be pretty good. So I think this dip creates a buying opportunity.
Well, we did talk to one strategist yesterday, Dory, who said that, or at least posed the question, is that outlook for earnings, though, already priced into stocks coming off of this, 24% or so rally that we've seen this year in the S&P 500?
Yes, absolutely it is. I mean, the market's rich, right? We know that. But as, and when we kind of keep going back to the irrational exuberance speech, right, which took 4 years before the bubble popped, but that was a very different market. A lot of those stocks didn't make money, right? And so here we've got a rich stock market. We got high PEs. But when you look at NVIDIA, and I'm sorry, we got to focus on NVIDIA. It's the big monster. It's the big one of the Mag 7. It's driving the Mag 7, and Mag 7's driving S&P, and that's driving the market, right? So you have to have an opinion on NVIDIA. But, if you can get that stock at 30 to 40 PE, and the outlook is still very rosy for it, and you're talking about a company that makes 56% net profit margins and 120 some odd percent return on equity, and it's growing like crazy, and all the other Mag 7s are dependent on it, that's way different than what we had in 2000. And until I see a robust, excessive M&A market and excessive IPO market, I think you can hug into some good quality stocks when they dip and still do just fine.
All right, NVIDIA is a kahuna. I want to talk to you about the kahuna of the bond market, the 10-year yield, which has risen, as you note, since the Fed started cutting rates. We've also seen the dollar, just mentioned the dollar. That has risen to multi-year highs. That has been pressuring risk markets as well. What do you see coming in the following year for rates and the dollar?
Yeah, Jared, I think that's a good point. No one is talking about the possibility of raising rates. Okay. And I think that is a very real possibility, looking at what's going on if this thing keeps heating up. So that 10-year is going to put a break, which is what I think your implication is. That's going to put a break on the stock market for going up and cause these growth stocks to, limit some of their upside, at least in the short term.
We always talk about the Fed being data dependent. What do you think would lead to a hike? And I believe you think we could still get a couple of cuts this year, but then perhaps the beginning of a new hiking cycle. What do you think that looks like? What are the circumstances?
I think so. Now to me, and of course it's hard to say, and the Fed sees different data than I do, but I know this, the Fed doesn't trust the data any more than I do. And so they're flying in the dark a little bit. But I'd like to see them pause a little bit to get a little more information. But they've had a tendency to jump out there. I thought the 50 basis point cut was a jump. I'm not sure if we needed this last one. I'd like to see them pause and get more data. But absent that, yeah, this scenario of cutting rates and then actually having to come back around and raise rates is a very real possibility. So if you see inflation take off, that's the first thing that they're monitoring. Then that's going to tell them, whoops, we're going to have to do a turnaround.
All right, Dory, enough on the chips and NVIDIA. Want to focus on some of the other parts of the market here. Energy is leading today. I know you're looking at that. And banking as well. XLF, the large cap financials ETF, one of the top ETF returns of the year. What do you think of some of the other sectors?
Yeah, absolutely. Well, you can tell by my accent, I got to know something about energy just because I'm in Texas. But I think we still have a supply issue, and the energy guys, the oil and gas guys, they're not going to drill like crazy. The drill baby drill thing is gone. It'll be drill discipline drill, and they'll get a green light. It'll be really good, but they'll be disciplined about it because they're really worried about having capital to access. So I think we could see good, stable markets in energy going forward. Develop some energy independence here. And, within 6 months to a year, maybe even see prices go up, which would be good. So it's probably a good time to jump into something like an Exxon that's real stable, gives you a nice, 4% dividend or something close to that. Then you can also get a higher dividend in something like Energy Transfer, or you can follow Buffett, and IXIC and probably do pretty well there. As far as banks go, I think the play is probably a little bit better in the community banks than it is the larger banks. We've lost a lot of the Trump bump that we had in the market and in banks, which got it. But the reason is still there, and that is an ease of regulation. That regulation has been extremely restrictive, and not only for banking and what it's doing, but in mergers and acquisitions. So you take a community bank that's growing, has good solid equity in it, has a good margin, good deposits, and is able to acquire, and you can buy it at below a 12 PE multiple. I think it's a good market for that kind of business.
Dory, thanks. Some ideas for investors there, and Happy New Year to you.
Thank you.
We want to check out shares now of U.S. Steel. They are spiking almost 12%. The Washington Post reporting that Nippon Steel is sending a new proposal for the American steelmaker, and that new offer would give the U.S. government a veto over any reduction in U.S. Steel's production capacity. All of this according to the Washington Post, which is citing a document sent to the White House. So this new development doesn't have to do necessarily with the two parties themselves, but with all of this concern over whether, from Nippon that is, over whether the White House, whether a Biden or a Trump White House is going to approve this deal. Trump's sort of gone back and forth a little bit. Biden has signaled resistance to this, and so has the union, the steelmakers union. So that's really the crux of the issue here.
Yeah, and I mean, the steel manufacturers were kind of a pillar of the first Trump presidency, and so that's one of the reasons why this is front and center in people's minds right now because of this latest headline. But let's look at the stock reaction here. I have steel manufacturers on our heat map. This is what's happening today. I'm going to dial up U.S. Steel, which is up 11.34%, and you can see here's the September. We had a bump into September, then the election came, and it's been down since then a little bit of a bump up. Very choppy, but bottom line, it's down 30% for the year. This is a year when the S&P 500 is up 20%. Let me just show you year to date how this class is doing, and you will kind of make the conclusions for yourself there. It's been a tough slog for these guys.
It has. So we'll see if Nippon's new concessions here, this 10-year guarantee that it won't cut production capacity in certain states, will end up helping it seal the deal. We're just getting started here on Market Domination. Coming up, Federal Reserve Chair Jay Powell on a collision course with President-elect Donald Trump. What to expect since they've clashed over policy in the past. Plus, some of the biggest moves in the commodity market aren't in gold or oil. We'll tell you which ones and how you could be paying for it ahead. Plus, we're counting down to 2025, and we wanted to take a live look at Times Square. Not quite midnight there quite yet, but about 1 million people are expected to watch the ball drop in person. And the clock is just striking midnight in other places like Dubai. That's where thousands of people have filled the streets to ring in 2025. We'll be right back.
President-elect Donald Trump and Federal Reserve Chair Jay Powell have clashed before, and there's a chance they will do so again in 2025. Joining us now is Yahoo Finance's Jennifer Schonberger. Jennifer, what's the deal here?
Hey, Jared. Happy New Year to you. Tensions have cooled recently between President-elect Donald Trump and Fed Chair Jay Powell, but that could change next year. During his first term in office, Trump regularly criticized Powell and pushed for lower rates, with inflation now expected to remain higher than thought in 2025 and uncertainty surrounding the impact of Trump's forthcoming policies on the U.S. economy. That could cause the central bank to set interest rates in a way that doesn't jive with what Trump wants, potentially putting the Fed on a collision course with the new president. Powell and company already expect inflation to remain more elevated than thought next year, ending 2025 at 2.5% instead of a previous forecast for 2.2%. That's caused the central bank to scale back the number of expected rate cuts next year to 2 from 4 previously. If Trump's proposed policies, from tariffs to tax cuts, cause more inflation, that could force the Fed to pull back even more on any easing. Any pause or even tightening could inflame the delicate détente between Trump and Powell if Trump further pushes and pressures Powell. Back to you.
Jen, thank you. Appreciate it. For more on what next year's economy could look like, joining us now, Olu Omo-Dunbi, Huntington Private Bank Chief Economist. Olu, thank you for being here. You just heard a little bit about the potential tension between the Federal Reserve and Jay Powell and Donald Trump. But I want to talk about the Fed a little more broadly here, because it does seem like we are still maybe sort of dealing with repercussions of the Fed's last decision, as well as press conference, and then what's going to happen going into next year. We just talked to someone earlier in the show who said maybe after 2 cuts this year, we could even get hikes beyond that. What are you watching that you think will be informing the Fed most?
Well, thanks for having me, Julie, and happy holidays. First, we think it's, at this point, we think it's unlikely that we get hikes. We think it's more likely that we get pauses. We think that the Fed is paying very close attention to inflation data. The Fed has a reaction function, so they look at income and economic data, and they react based off income and economic data. And based off inflation this year, inflation has been pretty much sideways, particularly over the past 3 months. PCE inflation was 2.6% in January of this year. It was 2.4% in November. Core inflation has also been very sticky. So we think that, if inflation doesn't slow as the Fed expects in 2025, then we're likely to see more pauses. But our baseline forecast is that we get 2 to 3 25 basis point cuts in 2025. But again, if we do get a reacceleration in inflation, or if inflation doesn't decelerate as the Fed expects, we're likely to see less Fed cuts than our baseline forecast.
And what about the labor market, Olu? Just thinking about the jobs market, we have the monthly non-farm payrolls, which have been steady, surprisingly steady all year long. Jobless claims also, they've spiked in a few weeks, but really haven't been a cause for concern. What are you looking for there as potential hairbingers of maybe some trouble in 2024?
Right, so it's still a good, sure. It's still a good labor market. So the labor market went from being very good to good. Last year, job growth, particularly early last year, job growth was averaging over 200,000. That was clearly unsustainable. Job growth is weakened in 2024. We've seen an increase in the unemployment rates. We've also seen some slowing in wage growth. We've also seen declines in quit rates. Several labor market indicators are pointing to a weaker labor market. But again, it's still a good labor market. It's still supporting the U.S. economy. Wage growth exceeds inflation, so that's a positive for consumers. We think that if we see big declines in employment, that will be a sign, for the Fed to react again, by cutting rates more aggressively than what they forecast at the December Fed meeting.
Of course, Olu, when we look at inflation, it is still above the Fed's 2% target. We've got an administration coming in whose policies, particularly with regard to trade, some economists have said is going to be further inflationary. Is that what you expect? And what are you looking at in terms of inflation targets for 2025?
Right, so there are a lot of unknowns there in terms of potential policies, but I think in order to evaluate the potential impacts of tariffs, I think it's important to look at what happened during President-elect Trump's first term. So between 2016 and 2020, when tariffs were implemented, they were implemented on just limited goods such as washing machines, aluminum, and so on. We didn't see any big acceleration in inflation. Actually, inflation went up from 2.1% in 2017 to 2.4% in 2018. And inflation in 2019 and 2020 were actually below 2%. So it depends on a lot of things. It depends on the transmission mechanism. It depends on how extreme the tariffs will be. And so there's so many factors that come into play in terms of how tariffs will affect the U.S. economy, particularly inflation. But our view is that, if extreme tariffs are implemented, if broad-based tariffs are implemented, there will likely be an inflationary shock. There will be an increase in price levels, and that could make the Fed's job more difficult in 2025. So that could result in less rate cuts than what we're currently forecasting.
Can you talk to us about the housing market and specifically rates? Because I'm looking at the 30-year at about 6.85%. It's off the highs which we saw in late 2023. But you're expecting rates to moderate next year. But at the same time, I'm also seeing that since the Federal Reserve started cutting rates in September, we were just talking about this with the last guest, we've seen the 10-year actually rise. So what forces do you see at work in the rates market for mortgages?
That's a great point. We've seen a spike in 10-year yields since the Fed's meeting in September. There's several factors that affect the 10-year yield. Fed policy expectations, inflation expectations, a term premium, and so on. But I think what could be a play. We think what could be a play here is just really the strength of the U.S. economy. The U.S. economy has been particularly strong this year. It's been stellar, particularly when you compare it with other G7 economies. GDP for Q3 was revised higher to 3.1%. GDP in the second quarter was above the longer run pace. It was at 2.8% on an annualized basis. And several economic indicators just point to a strong U.S. economy. And we think that's partly why we're seeing those upward pressures on long-term yields. Now, in terms of housing is an interest rate sensitive sector, and it's been weak for a couple of years. But we do expect that we're going to see more inventory come online. Actually, if you look at existing homes for sale, we've seen a slight increase this year. So we do expect that we're going to see more homes come online next year, and that should lead to slower house price growth in 2025.
Here's hoping. Olu, thank you. Appreciate your time.
Thanks, Julie.
Now time for some of today's trending tickers. You can scan the QR code below to check out the best and worst performing stocks of the session on our trending tickers page. Let's start off on China. Stocks reacting to a televised speech from Chinese President Xi Jinping earlier. He said the nation's economy is, quote, on an upward trajectory. He also confirmed that GDP grew at around 5% for 2024. The official precise report on that doesn't come out until next month, but this sort of proved to be reassuring to markets. And then there have been reports that once again, the growth target for 2025 will be 5%. That doesn't come out until March on an official basis. But we're coming off a strong year for Chinese stocks because of anticipation of more stimulus, maybe finally being a little bit more successful.
Yes, and to be fair, they have thrown a lot at this, and I can go through just a few of these. They've had interest rate reductions, reserve requirement ratio cuts, so that has to do with lending standards, liquidity support to $148 billion worth, sovereign bonds, special sovereign bonds, local government debt managed for $1.4 trillion, consumer subsidies, stock market support, and a monetary policy shift. So for the first time in 14 years, China is now moderately loose in its monetary stance. But yes, we're still looking for more because this has been kind of an issue. You're seeing a heat map on your screen. I just want to show you what's happened since all these bazooka stimulus measures were announced since September, and it's not all green. So it hasn't even been enough for a lot of these names like Alibaba and IXIC.
Yeah, nonetheless, Chinese stocks are going to have their first gain on the annual basis going back to 2020. Collectively.
There you go. And Sangamo shares sinking after Pfizer ends a gene therapy deal with the company. Joining us to talk more about the move is Yahoo Finance senior health reporter Anjali Khemlani. Anjali, what's the latest?
That's right, Jared. Well, unfortunately, this stock really down quite a bit, down more than 50% today, and the biggest loss in 16 years for the company. It's a small, late-stage clinical trial company that had its hopes pinned on getting to its first commercially viable product with this deal with Pfizer, looking at the hemophilia product that had really positive results in July. And now with this surprise move by Pfizer, according to the company's CEO, they are now kind of in a shaky area financially. They're now looking at having about 10 million alone as net income from the third quarter, and cash on hand is about 40 million. So we're talking about smaller numbers here, of course, for a smaller biotech like this company. The company does have a few other products with partners like Takeda, a Roche subsidiary, as well as an AstraZeneca subsidiary. So they do have some preclinical trial things going on there, but that's really it for right now. And then their other product that is getting into later stages is a Fabry disease product, and that is going to be one that they need a partner to get to the finish line, likely based on the way their financials are panned out. So as of their last quarter, they did tell investors that they have enough cash on hand, they have enough to make it to the first quarter of 2025, and then that's when the application was supposed to go in. So questions now.
Just quickly, this hemophilia A drug that they were developing with Pfizer, why did Pfizer pull the plug on it?
Yeah, there's questions about that. A lot of analysts are looking at what is out there in the market right now. There is one other similar drug, and there hasn't been too much of a rush behind it, and so that could be a reason. It also could be Pfizer making moves. We've seen the company really take a look at its strategic planning for the upcoming years. Pfizer itself is under pressure. We've talked about it many times on the show about how much that company has had to reorient and the expectations in this post-pandemic world as it weans off of those COVID highs. So that's really what the situation is right now for these two companies.
Yeah, and Pfizer shares are up today, but not, like a tiny amount.
Tiny amount.
Interesting. Thanks
All
so
right.
much.
Thank you for that, Anjali Khemlani. And up next, some of the biggest moves in the commodity market aren't in gold or oil. We're going to tell you which ones and how it could be that you're paying for it. Up ahead. We are on Commodity Watch, and some of the biggest moves this year weren't in oil or gold, but instead in cocoa and coffee. Cocoa prices more than doubling this year. It's the top performing commodity of the year, and supply concerns and thin trading are kind of driving that action. For coffee, on the other hand, it's up more than 70%, and that means that for you, probably likely higher prices at the grocery store. So joining us now is Phil Strebel. He is a Blue Line Futures Chief Market Strategist. Please talk to us about some of the recent market action that we see in the softs here.
Yeah, if you look at the soft commodities, I mean, these have been explosive. These have way outperformed some of your basic commodities out there, even your stock indices. When you start to play some roles like weather and consumer demand and export restrictions, as well as competition to secure supplies, they all become these drivers of these various commodity markets. And then, of course, again, not only the weather, but the infrastructure here. Many of these commodities are grown overseas, and they lack the resources here to really hone in and drive excess supply out there. They've got a lot of products out there that are just more healthy made. They don't have genetic modified seeds and things like that. So these commodities are very susceptible to any kind of adverse weather scenarios. And that's where you get these products like cocoa and coffee really moving higher, especially with drought and flooding concerns.
Yeah, I mean, we've seen incredible spikes here, Phil. Something we've been talking about today has been the weakness that we've been seeing in other types of commodities, in part because of the inverse trade with the U.S. dollar. When you're looking at the softs here and these sort of supply shocks, how do you factor in the dollar to all of that? Would the moves be even bigger, for example?
I mean, the dollar has been a benefit for us because of the fact that we're a net importer of these. It would be really problematic if our dollar was extremely weak against some of these foreign currencies. So it's really helped out from that stance. And many of these commodities where they're grown at, we don't really have these like a tariff war going on whatsoever. Other than Mexico, there's a little bit of concern about it. Mexico is the largest agricultural trading partner with the U.S., but other commodities out there like sugar and cocoa and coffee, we just have less risk there. It would be more retaliatory in nature. But a lot of these commodities, again, when you get to like things like cocoa, you know, it's the top performing commodity, but the problem is that you have a poor harvest in the Ivory Coast and Ghana, where most of the commodities grown, the weather and the infrastructure related issues. They've had diseases in these crops that have caused rotting of the seeds because of the poor weather conditions. And then the stockpiles, they're just driven down because of the resilient customer. You look at the economy this year, it's been quite well. The consumer has been quite strong. And then the makers of these products, they really struggle to compete to secure supplies out there. Remember, the U.S. is the largest consumer of chocolate and coffee. It's just about everyone's favorite, thing to drink.
Yeah, and so that brings me to when I'm going to feel it, Phil. Where am I already? How quickly do these types of price spikes tend to make their way to consumers?
Wholesale prices have gone up 30% in the last 2 months, specifically on the coffee market. I mean, everybody, they kind of look at where eggs and beef and things like that, because those are staples. You start getting into coffee and cocoa, orange juice, they become a little bit more exotic of a product, but it becomes just second nature where, you know, maybe you're buying these basic commodities that you need in your household and you're putting a few things back. So people are feeling it, but maybe perhaps the fact that like other areas such as energy prices have come down quite a bit, maybe they're getting relief in certain areas. I know Jerome Powell said that some of the inflation areas have gone up in certain areas and they tend to OODA loop amongst one another, but they are remaining at these elevated levels right now. So I think that really the inflation, it's going to be here to stay. Now, it's a question of how does Trump's policies impact a lot of these different commodities, and do they start to cycle upwards is a whole nother thing.
Let me ask you about the metals here. We got under a minute. What about gold? Still up 28%, not as high as some of the softs we've been talking about, but the precious metals and just how that relates to inflation and Trump here.
Well, it really came down when you saw that only 2 interest rate cuts are expected in 2025 and 2026. If we do see inflation start to come down or the consumer more importantly, starts to break down and we see the labor numbers, like initial claims, start to stick up while you have that high inflation, you create stagflation, and that's where you get that level of gold futures starting to head higher. Also, central bank demand, if that continues to pick up, we saw China restart those, that's where you get gold futures going up as well.
Phil, good to see you. Happy New Year. Thanks for your time today.
Yeah, thanks for having me.
Turning to another big mover this year, big tech. There has been a lot of focus on the Mag 7. Even Broadcom, though, has emerged as one of the best performers in the S&P 500. For more on the tech landscape going into 2025, we're bringing in Ali Moghrabi, Senior Equity Analyst at West End Capital Management. Ali, it's good to see you here. So obviously, the Magnificent Seven, NVIDIA, of course, has been a big story. Well, the emergence of Broadcom, though, and the narrative that it is going to be perhaps the contract chip manufacturer of choice for AI has been an interesting development late in the year. How do you think that's going to play out next year, especially in comparison with NVIDIA?
Well, I think it's going to be beneficial for both, actually. So let's just stick with Broadcom for a second. For Broadcom specifically, I mean, if you look at AI, we're moving more towards from the training side, more towards the inference side. So basically, in other words, what to do with new data and how to interpret it and, bring about the answers. And so do the computation and bring about the answers. So that actually requires more customized types of chips. And that's where Broadcom comes into play. And we think they're going to be benefiting from that, of course. It's very likely that they're going to be working with OpenAI. They're going to extend their relationship, of course, with Apple in various areas. They certainly have been working with Google for a long time. So that's on the chip side. And then also there's a lot of connectivity network that's really needed for all of those chips to work together cohesively, and of course to do the computations very efficiently, very quickly, and these guys are actually one of the main players on the network / connectivity side of it too. So it's kind of like that flywheel that's going to start strengthening a little bit in 2025. That's going to benefit Broadcom. And then on the NVIDIA side, really quickly, I mean, these guys, of course, are dominating the GPU market, and the demand from the hyperscalers. Still growing well, but of course decelerating a little bit, and those are their clients. But enterprise specific companies that are building their own data centers, I think that's going to drive some demand for NVIDIA. And then of course the release of their Blackwell chips, whether it's 200 and I think the 300 is probably going to come out in the late first half of 2025. And that's more focused on the inference side of it, which we talked about. And these guys do have that network effect that we talked about Broadcom developing already. So NVIDIA remains in pretty good shape too.
Can we broaden this out to the entire chip space? Who among these companies might be a feature of 2025, might be an outperformer? Last year at the end of the year, it was clearly NVIDIA as the main story. This year it's NVIDIA with Broadcom as a latecomer, and investors are wondering what should we be nibbling on, if not chomping on next?
Well, Broadcom is the main one, we think. Management actually talked about, company specific, the addressable market, basically opportunities for Broadcom itself to generate revenues are going to be growing from around 15 to 20 billion currently to 60 to 90 billion through 2027. So that represents enormous growth opportunities for these guys to take advantage of. So in our opinion, it's right now chip specific. Right now, it's Broadcom.
And then when we talk about the Mag 7 overall, what do you make of this sort of late pullback that we have seen? In the past, of course, rates creeping up has been a stumbling block for tech. And that seems to be happening again, Ali. So what do you think that, does that continue to cause friction for these names going into 2025?
It's interesting. In my opinion, actually, the increased higher rates don't necessarily impact Mag 7 much. The reason higher rates impact the tech industry is because they make access to capital a little bit more difficult. But when you're talking about the Mag 7, you're talking about cash cows here. I mean, generating free cash flow easily. continuing to expand their margins. So they have more than enough capital at hand to continue to invest and continue to do research and development, come up with innovative products, and at the same time, of course, grow their current products. So I don't think they'll be impacted much by higher rates. I think what's currently happening is pretty much repositioning for a lot of portfolio managers, and also, of course, profit taking. So it seems that's the direction we've headed towards the last 2-3 weeks.
All right, we've been talking about the supply, and that would be the chips and the chip makers. What about the demand in terms of the hyperscalers, which we kind of touched on a little bit? What do you see demand in terms of CapEx and other factors being in the new year?
Yeah, demand, I think, is going to remain strong. On the CapEx side, as they have basically guided and hinted towards, 2025 is still going to be growing very, very nicely. Now, however, what's going to happen is they're going to be, most of them, I mean, if you want to talk about Google, if you want to talk about Amazon, they're going to be focusing on the inference side. And we talked about what inference is. And that's why they're going to be focusing on more deploying their customized chips towards that. And I think what they can do with that is come up with their own tools, and that's where the monetization comes into play. And it actually provides their clients, and we're talking about the cloud platforms that those players provide, it gives their clients more options to choose from. So, and then more specifically, I mean, if you're talking about Meta, also Amazon, also Google, they are deploying those AI-powered tools and features internally, for example, to make their advertising ROIs increase, more targeting, more specific targeted advertising. And that's, of course, going to attract the advertisers. Plus, think of it this way, they've got billions of eyeballs, right? So huge viewership there. Their ecosystem is very tightly integrated. And at the same time, it looks like, from a macro standpoint, the economy is going to continue to grow. Nominal GDP growth looks like it's going to do pretty well in 2025. So the demand from the advertisers is going to be there too. So it looks like all of that is going to be working pretty well for those three names that I mentioned in 2025.
We'll be watching them, Ali. Thank you so much. Appreciate it.
Sure.
Coming up on Market Domination, the push to privatize Fannie Mae and Freddie Mac. Billionaire investor Bill Ackman says it could happen in Trump's second term, but you'll want to hear what our next guest says about the implications for home buyers. We'll be right back.
There are growing bets that President-elect Trump will try to loosen the government's grip on Fannie Mae and Freddie Mac, and it would mark the end of a financial fight that's lasted nearly 2 decades. And here's how we got here. Fannie Mae and Freddie Mac are mortgage finance giants that came under the government control during the housing crisis. The firms play a central role in U.S. housing market because they buy mortgages from lenders and repackage them as securities. But when mortgage defaults soared in 2008, that's when the government took over. In 2012, Fannie and Freddie returned to profitability, and the government changed the terms of the takeover agreement by sweeping all the net profits into the Treasury Department as dividends. But investors took a hit, and then in 2019, the Trump administration started taking the first steps toward privatization, but they ran out of time, and that's where we are today. Trump allies are looking towards a resolution of this, but here we want to introduce Chris Whalen as our next guest. And if we have you, let's see here, Chairman of Whalen Global Advisors. Could you just give us a little bit of background about where we are right now and then how this is affecting mortgage holders and prospective home buyers who are unable to get into the market because of these sky-high rates?
Well, the GSEs, Fannie Mae, Freddie Mac, have been under government control for 16 years. And they function fine in terms of providing the services you just outlined. They buy mortgages, package them up, and sell them. They operate with a AAA rating from the United States because they're controlled by the government. If they're released, then they are going to become private entities. They're going to have ratings of, maybe AA, maybe single A plus in that ballpark if you read Moody's and the other agencies. And that's going to impact the cost of mortgages in the conventional market. They're going to be more expensive. Now, hopefully, it won't go up that much, but it could be significant. And I think you're going to see more differentiation between the conventional market, which is half of all mortgages in the U.S. today. It's about $7 trillion. And the government market, which is very competitive. It's really the best place for first-time home buyers and low-income buyers.
Hey, Chris, it's Julie here. So just to break this down a little bit further here. So basically what you have now is Fannie Mae, Freddie Mac, Ginnie Mae for that matter, they buy the mortgages that are not sort of the luxury homes over $1 million or so. It's sort of the middle of the market, first-time home buyers included in that market, and provide liquidity to that market. And with those AAA ratings or with those high ratings, they can keep rates at least relatively low relative to where we see interest rates. So in this scenario, what you're describing is if they lose those ratings, we will see rates go higher. But will there also be additional competition for those mortgages that could also help limit the increase in rates, or will there not be increased competition?
Well, Julie, first, if I might just correct one thing.
Of course.
The first-time home buyer goes to the FHA or the VA, and you go through the Ginnie Mae process. The Fannie Freddie people really control the fat middle of the market, and they can go up to $1.2 million now in high-priced markets like the West Coast, New York, the Northeast. So they perform a very important function, but they compete with the banks on the high end, and they also compete with Ginnie Mae on the low end. There were a lot of home buyers that migrated from government loans into Fannie and Freddie over the past few years. You may see that reverse because Ginnie Mae is so competitive compared to Fannie and Freddie. They're much more competitive in terms of the price of the mortgage to the consumer. And as you know, Julie, consumers are very switched on now. If they can save money, they will.
Right.
I hear this constantly from my clients. I work for some of the bigger issuers in the U.S. mortgage market. So, I think they are playing with fire here to some degree because Fannie and Freddie are going to have to compete with the banks, and they're going to have to compete with the non-bank issuers who have become extremely competitive over the past decade. Think about it. We may release Fannie and Freddie in 27, thereabouts. We could be having a mortgage market correction by then. So there's a lot of issues we have to think about and talk about over the next couple of years before these entities are released from government control.
So if the private mortgage market has come on strong recently, does that Does that really impinge on the government? And is that even a problem? I mean, if the market is going towards privatization anyway, is this just a case of the government needing to, I guess, bow out and kind of relinquish control any that it has?
Well, in an ideal world, I would like to see that happen. Exactly what you said. Fannie and Freddie, if they could step back and be a backstop for the market and let banks and non-banks compete for those loans. The reality is, though, most of the issuers who want those private mortgages want big mortgages. They want mortgages over $1 million. So if you want to serve the public interest, which is to have a liquid market with 30-year mortgages, right, you have to take the good with the bad. The large investors, the BlackRocks and the PIMCOs, they would love to buy those big mortgages and put them in their portfolio. You don't even have to issue securities. JP Morgan is very competitive. They're the biggest servicer in the country now, but they don't want to do small mortgages. They want big mortgages. They don't want low-income families. They want affluent people with the mortgages, so there's no default risk. So I think what you have to realize is that since the great financial crisis, a lot has changed in mortgages. And Fannie Mae and Freddie Mac are going to have to compete in a very different world. We can't go back to before 2008. It's just not possible. So I think we have to think long and hard about how we structure these transactions to make sure that, sure, if the private sector wants to take those bigger mortgages, great. But Fannie and Freddie aren't going to do very well if they lose that business. It's a very important distinction.
Chris, I want to bring in who's pushing for this privatization on the private sector side, namely people like Bill Ackman, John Paulson. Ackman,
Sure.
of course, just tweeting about it. So it sounds like from what you're saying, it's not a given that these companies come out of conservatorship and are enormously financially successful. Right?
No,
so
I agree with you completely.
So
and I think the industry is going to fight it, Julie, for exactly the reason you just said.
And so what are the implications then for these big investors who are in them?
I think the trade here has been coming out with positive statements about release, and the stocks have done very well. If you just look at your own chart there on Yahoo, they're up hundreds of percent in the last 12 months. So it's been a trade. Are these companies going to be good long-term investments for retail investors? I would say no. And I think we have to distinguish very specifically between those two scenarios. Trade the stocks if that's your style. If you like to day trade, fine. There's a lot of volatility here. But these are very small penny stocks, and you have to, be very careful about what you recommend to retail investors. On the other hand, the long-term prospects, I think, is a big question mark. I really do, Julie. I can't see United Wholesale Mortgage and Penny Mac and Freedom and Mr. Cooper just allowing the GSEs to continue as they are after they've been downgraded by Moody's and the other rating agencies. When you're a single A plus, your spreads could widen half a point. And
Chris,
consumers are going to pay for that.
Sorry to interrupt you here. We're up against a hard break and we got to go, but thank you for stopping by.
Happy holiday.
You too.
While we're wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.
there's the closing bell on Wall Street, and now it is market domination overtime. Let's see where the major averages closed on the final trading day of the year. Down 4 straight sessions for the S&P 500, off by 0.4% on the day, and off by more than 3%, I believe, over the 4-day period. The Dow closing lower by 28 points, just about 0.1%, and the Nasdaq leading declines, off by 0.9%. So this selling pressure, so interesting here, Jared, not really abating here to close out the year.
Yes, and a couple different ways to look at that. First, this is the end of the year and things are supposed to go up because there's not a lot going on. So the Santa Claus rally is in play, and if these 7 days, and it's 7 trading days that span the close of one year and the beginning of the next, if they end negative, it portends negative results for 2025. So that's what we're looking at. But then also we saw such outperformance this year in equities that some people are saying, well, the bond market saw some selling and had to catch up. But let's get back to the main markets here. S&P 500 up 23.31% year to date. This is the best year since 2023. So
and the first back-to-back years of 20% plus gains since 1998.
Yes, and I believe
I'm not mistaken.
It was 98 or 99, and I think it was 4 in a row back then. So people are thinking, well, is this a repeat? Is this like the roaring 1920s? And so that's kind of where people's heads are going. I want to get to the sector action. We'll take a look at what happened today. That is energy, the biggest gainer. That was up 1.34%, and you can see on a year-to-date basis, up only 2.19%. Actually gave back a lot of those gains towards the end of the year. Here's the year-to-date. Here's how we're ending up. Guess what? The 3 mega cap sectors, XLC, that has Alphabet and Meta. We have financials, and then another mega cap sector that has Amazon and Tesla, that's consumer discretionary. All of those up more than 25%. Those are the only ones that did better than the S&P 500, which I'm circling right there. Materials was the only loser. And I'd be remiss if we didn't take a look at the crypto market as well. And we are looking at year-to-date gains of 111.5% in Bitcoin. And let me just rattle off some stats real quickly with regard to some of the fund flows, because we got these spot Bitcoin ETFs in January, and they have just been on fire. In fact, iShares Bitcoin Trust ETF, that's IBIT, that has been the fastest growing ETF in history according to some metrics, depending on how you slice and dice it. You can see 52.15 billion in assets. It's seen flows of 37.27 billion. How could it have more assets than flows? Well, because prices have accumulated, have appreciated. And number 2 is actually quite a distant second. That would be Fidelity Wise Origin Bitcoin Fund. That has 1-year flows of 11.8 billion and assets of 18.9 billion. But basically, iShares was the big winner this year, and just a lot going on in crypto in general.
Yes, most definitely. A lot going. That's a little bit of an understatement, even.
I'm all about understatements on the final day of the year.
All right, stocks closed little change for the day, but it was a banner year for the stock market. Joining us now, Michael Green, Simplify Asset Management Chief Strategist and Portfolio Manager. Michael, it's good to see you. I want to talk to you specifically, actually, about the last month or so of trading, because it has been so different in sort of tone, if you will, from what had preceded it. And you have an interesting view on kind of the phases of the sell-off that we have seen. Can you walk us through that?
Yeah, no, so the easiest way to think about what transpired in December, particularly in the last few days of it, was that the lead into it, December was actually quite bullish. I think people were looking at markets as being very strong, until, of course, Jerome Powell disappointed with what's referred to as a hawkish cut. Strong language indicating that they will reduce the number of cuts expected for 2025, at the same time indicating that they think that inflation concerns are largely overblown, that we're seeing this move from market-based prices to imputed prices, which they don't think actually tells us that much. It was broadly perceived as kind of a wishy-washy report. That in turn led to a sell-off in rates. And at that point, things started to get kind of interesting because of the performance that you've talked about. We've seen equities outperform bonds so strongly through the course of the year that a rebalancing of portfolios, particularly systematically rebalanced portfolios, had to kick in the last week or so. This is a pattern with systematic rebalancing strategies. They don't care about what is the level of interest rates or what's the PE ratio on stocks. They're simply looking at how the portfolio is allocated. And if you pull up the kind of intraday components, you can actually very mechanically see the relationship between bonds and equities flip in that period after Powell. We saw effectively the market begin to respond negatively, or the inverse relationship between bond prices and equity prices, suggesting that portfolios were trying to rebalance into more bonds and less equities, consistent with a mandate, say a 60-40 or a target date fund that is targeting a particular level of fixed income. It really does feel that this was much more of a mechanical process at the tail end of the year as compared to a thoughtful exercise on what 2025 looks like.
And what about the month of January? A lot of people look to January as a barometer for the entire year. You see fund flows. Just kind of walk us through some of the dynamics that you might expect for the new month.
Well, I think one of the most interesting things is how easily we start talking about fund flows and how we know that those impact markets. At the same time, we also broadly sit aside and say, well, passive investing with its massive flows can't impact markets. A lot of my research is actually very much in contrast to that. I heard you reference earlier this idea that the last few days of December tend to portend a component of what happens in the coming year. I think there's some truth to that, and what it would suggest to me is part of what we're seeing is people trying to get ahead of that perceived selling going into January. There's been a lot of extraordinary gains that have occurred in companies in some of the indices that you mentioned, things like the communications or technology industry. You've seen very, very strong gains with expectation for Trump to cut taxes in 2025. The obvious incentive is to not take profits in 2024, pushing them off for another year. I think a lot of people started to realize that this was a very consensus component, and it feels also that there's probably some attempt to get ahead of that. We saw that type of behavior at the tail end of 2021 into 2022 when you saw the tax selling at the start of the year. And then, of course, the shift to Fed hikes, which again played through this portfolio rebalance channel that I was referring to. Higher interest rates, lower bonds in a balanced portfolio or any sort of systematically rebalanced portfolio. You have to sell equities and buy bonds to rebalance your portfolio. That really explains a lot of what we saw in 22. It's going to be very interesting to see how 2024 or 2025 plays out in the context of expectations now having largely been reduced for interest rate cuts in 2025. My gut tells me that Powell will be cutting more. That'll be supportive for the bond market and ultimately relatively supportive for the equity market, unless, of course, the economy deteriorates sharply.
What would cause that last thing to happen, Michael? What are you watching?
Well, I'm paying very, very close attention to the labor market, and I would suggest that Powell is as well. It's really interesting that at this last press conference, he's tried to redirect the market away from headline numbers on CPI or core numbers on CPI, and really introduce this idea of market-based versus imputed. Imputed costs are ones which market prices don't really exist. They're an estimate of what's actually happening. The most famous of these is the owner's equivalent rent component, which has been running way above the levels that we're seeing for private market indicators of housing inflation. That's very much in contrast to the pre-pandemic period, and it reflects an element of catch-up that's occurring. What Powell told you very specifically is that doesn't tell you very much about what's happening to the economy or prices, because it's a mechanically slow-moving average that's catching up. Instead, he directed us to the labor market, which has been deteriorating. We've seen unemployment rise, particularly for younger people. Those who are graduating from college are experiencing one of the worst hiring environments that we've seen for young people outside of a major recession like 2008. That was then followed up by a tweet by Nick Timiraos, the quote-unquote Fed whisperer at the Wall Street Journal, who highlighted the extent of continuing claims moving higher. That suggests to me that Powell is very much focused on the labor market, and that's really where I think our attention should be placed as well. The really critical thing for people to watch for is what's called a revision from the quarterly census on employment and wages. That hits in February of 2025. And at that point, something, Julie, I know you've heard me talk about, the birth-death model, that actually starts to change in its underlying construction and suggests that we'll see far less favorable non-farm payrolls reports, which have been underpinning a lot of the economic data that we've received.
Michael, really appreciate your insights here. We have to leave it there. And thank you for joining us here. And coming up, a look at what we might expect from the IPO market in 2025. More market domination over time coming up.
Focus on the trends, focus on those earnings reports. We're seeing earnings growth. Block out the noise.
Don't let emotions drive your investment decisions. Really important. Things like FOMO, you want to try to avoid that.
We're still bullish on stocks and would suggest to stay invested.
Pay attention to both their equity portfolios and their fixed income portfolios. Constantly reevaluate, are trades working, what's good out there, what should they be involved in.
Don't make any outsized bets based on potential policy or based on anything specifically coming out from Washington. Having a disciplined process over time across asset classes, within asset classes, is really important.
One thing we think is incredibly important in 2025 is that investors do not become too complacent. There has been a lot of optimism, a lot of good news heading into this year, but we don't want to turn a blind eye to potential risks that are out there.
2024 is in the books for the market. Here's the scorecard. And let's go to the Wi-Fi Interactive, where I'm going to dial up the S&P 500. Here we are, 23.31% in the books. Best year since last year, but only a few months ago, we were tracking the best year since 1997. Didn't quite end that way. And let's take a look at the Dow, ending on a down note today, but still up almost 13% for the year. And the Nasdaq, the tech-heavy Nasdaq, where the action oftentimes is, that was up 28.6%. 6%. And then we'll also do the Nasdaq 100 there, which is a little bit more large cap weighted, and it's less than Nasdaq cap, not quite 25%. I think it's instructive too if we look at the small caps, because the small caps have been underperforming for years, and it looked like they were going to break to a record high. They got an intraday record high for one day, but couldn't get that closing. And then it was kind of a sell-off from there, so ending on a bit of a downstream or a down note for the month of December. And let's take a look at volatility, because we got some volatility shocks this year. One of them was on what I call Yen-mageddon. That was August 5th. That's when the yen got a little bit out of control and the Japanese had to manage their bond market. Some goings on with their monetary policy. That spilled over. That was the biggest spike of the year. But we also had a few after that, some aftershocks here, not the least of which was in December after that last policy meeting of the U.S. central bank. That would be the Federal Reserve. So central banks really driving the bus in volatility this year. And we got to take a look at the bond market. Speaking of volatility, 10-year T-note yield ending close to the highest of the year. And those highs were back in late April, early May. It has been on a tear since we saw Trump elected for 2025. Also, the U.S. dollar index at multi-year highs here. That's going to be the potential dollar wrecking ball is going to be in sights for investors in the new year. And let's get to some heat maps here. These are the winning sectors, and you can only see one losing sector here. That would be materials, but the mega caps really dominated with communication services, consumer discretionary, but also sandwiched in the middle there, financials. And then tech, you asked? Tech was underperforming the S&P 500, but still turned in a solid 20%, 20.8%. Close behind it was utilities, that quasi-AI play that we've been talking about as well. And let's get to the Nasdaq 100, where we can see mega caps got a lot of love this year. Microsoft, the least favorable among them, but nevertheless ending with 12% returns this year. Tesla, a little bit late to the game. Here's a year-to-date chart. You can see just really taking off after the election. That's when most of these gains came, up 62%. And finally, the winner, NVIDIA, up 171.2% year to date, and also a big winner last year as well. Julie?
Thanks, Jared. Turning now to the IPO market. After 2020 and 2021 saw more than 1,500 companies go public, the next 3 years each saw a below average number of IPOs, combining for just 559 total. So with an expected looser regulatory environment under Donald Trump and the possibility of more rate cuts, will 2025 see that flood of companies finally rushing back to the public market? Joining us now is Ben Miller, Fundrise co-founder and CEO. Ben, thank you so much for joining us. This feels like it has been anticipated for a while, and it hasn't quite come to fruition. What is it, the new administration? What is going to be the thing that is going to switch the IPO market back on?
Well, our fund invested in a bunch of these great private tech companies that have been waiting to go public. You saw ServiceTitan go public a couple weeks ago and pop 44% in a single day. So what that showed is a green light to the market. Essentially, the stock market is verging on bubble pricing. Some of the PE or the price to book for the market is peaking in the top 5% in the last 20, 30 years. And so if you're a private tech company, you want to sell into that bubble. And so now you're seeing a lot of companies come off the sidelines and say, okay, this is going to be the year 2025 to go IPO.
At the same time, and it just seems like that the impetus for these companies to go public at all, they don't seem to be in a rush because they are able to raise money in private markets as well. And I've had some folks tell me that, it is onerous to go public, not just to go public, but to be public, right? Because of regulatory costs and such. Do you think that part is going to be changing?
No, I don't think the regulatory burden is going to change under this administration. It's not just the regulatory side of it. And I run a tech company, it's also that the public markets put a lot of short-term pressure on you. You see the stock price change every day. It changes the culture of the organization. Everybody's focused on day-to-day pricing rather than building a long-term business. And then you have hedge funds and activists all putting pressure on you for quarterly output rather than long-term outcomes. And so a lot of companies really don't want to go public until they feel like they are at a phase where they're not really going to be driving a lot of volatility in their innovation. And so it's one of the reasons you see much higher growth companies in the private markets than the public markets. Essentially, when you go public, you're sort of signing up for a lot more of meet and beat quarterly forecasts rather than focused on the highest growth, highest amount of innovation.
I want to ask you about the pipeline here for startups, and we're talking about IPOs. But before that, we do have a series rounds that that companies must go through. I've talked to a number of startup and VC operators in the past year, and it's been really since the last 2 quarters that the IPO market was frozen. Then we saw some liquidity come back into it. What do you see as the pipeline being for 2025 to fill that for 2026 and beyond?
I mean, there are hundreds of really good companies waiting to go public. I mean, we're in our portfolio, Canva. I think they're a world-class company. I wouldn't be surprised if they go public. I don't know. We invested in Databricks. I don't know if they'll be going public in 2025. But you see that there's a number, more than a dozen companies with, hundreds of millions of billions of dollars in revenue that are ready to go public. And it's really a question of, is the juice worth the squeeze? Because as you saw when the ServiceTitan went public, there was a 44% pop on day one. So what happened was essentially is that the IPO investors got this 44% gift by coming in pre-trading, and I mean it's great for our investors. That's why we created our fund, invest in pre-IPO companies. But at the same time, if you're a company, you sort of feel like you left a lot of money on the table. And so I think you'll see a number of really big companies go public, but I do think a lot of these companies are still focused on what is driving their own growth, whether it's Stripe or Databricks, they're focused on AI, they're focused on a lot of change that's happening in the market. And there's really no hurry to go public really these days because the private markets provide plenty of liquidity.
And let me ask you this, Ben. Of these companies that could potentially go public next year, is there one that you think is going to be like the hottest, that people are going to fall all over themselves to get in on?
Next year, I mean, I think that the most exciting one would be Databricks. I wouldn't be surprised. I mean, this is kind of like, I don't know if it'll be next year, but it might be 26. I think you may actually see OpenAI go public. It's one of those things that you wouldn't think, but I believe at some point the amount of capital they need to raise, the public markets are really the best place to raise it. And I think that what that company is doing is so extraordinary that I think that it would make sense for them to actually go public.
Yeah, something to think about because they're structured kind of as a nonprofit now. I did want to ask you about the AI trade, so that's a perfect lead-in. What about some other companies in the field? We've seen the leaders just dominate the returns over the last few years, but what about in the IPO market?
Yeah, I mean, we're invested in Anthropic. We're invested in basically all the top AI companies. AI is, as at least Gen AI, really only has been around for a few years, and so it's arguably premature for a company to go public. You really want that period of innovation and sort of volatility to happen in the private markets. However, these companies need to raise so much capital. I mean, they're so capital intensive as they build their models. We might be surprised to see some of these companies start to look to the public markets, especially if the public markets are going to reward them, which we saw with ServiceTitan. So I think Databricks is probably the bellwether for that, and I think that they are a very good AI company. But it's just a question of, for the last 2 years, the market rewarded profitability over growth, and AI is just all about growth. It's all about driving disruptive change, and if the market will shift their values to focusing on growth rather than on profitability, then I think the market would be, then these private tech companies really would be ready to go public.
All right, we got to leave it there, but thank you, Ben. And
thanks
new
for having
data
me.
shows 250 drugs will see price increases next year, marking another year that prices will increase more than inflation. Joining us now is Yahoo Finance's Anjali Kemlani. So what are the details of these price hikes?
The details are to know that this is actually not new. We know that every year the drug companies do increase a number of drugs. Now 250 is quite a large number compared to last year was 140, but that number also varies every year. The thing to know is that when we're looking at these drug increases, on average, the industry has been looking at a less than 10% increase year over year. And in some cases, in some years, if you adjust for inflation, it's actually a negative number for those prices. And we're looking specifically at list prices, which is different from those net prices. So that's where a lot of discrepancy and confusion as well as controversy comes from with these prices. We do know that one interesting factor that's going to be affecting the drug prices for next year is going to be the Inflation Reduction Act for Medicare, that $2,000 cap for patients out of pocket. We're going to see how much that impacts how these companies price, as well as what do insurers do for the upcoming year and beyond that once they start to see the impact of those price caps of patient out of pockets. Now, another thing to note is that we did see sort of a decrease in the second half of the last decade as these companies have been seeing more and more political pressure and having that come down. So that's something to just keep an eye on. We've also seen some, there you go, that chart, that's what I was looking for, to kind of tell you how all over the place it's been. You can see that what I was talking about the last half of the decade, and then a slight increases from there. So it's something that keeps changing and something that we just keep an eye on every year.
Well, and as you made it clear, there's the list price, and then there's the actual price that insurers pay and then individuals pay, and bringing sort of enmeshed in the middle of all of that is the sector that's in the midst of this huge debate in Washington, which is pharmacy benefit managers. They're the middleman. And so when prices go up by a certain amount, how much does that actually end up flowing through to whoever's paying?
And that's the question, right? How much of it is an increase because of the amount that goes to these middlemen? How much of it is because of actual cost and inflation? We have seen that the medical commodities in the inflation numbers has been pretty consistent over the last several years compared to medical care, which is the healthcare services and the like. So you're looking at a mixed bag of numbers here.
Just thanks a lot. Appreciate it. Well, that'll do it for today's Market Domination Overtime. Thanks, Jared, for sitting in with me today. Be sure to come back on Thursday at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. Don't come here tomorrow. Go have some champagne. Happy New Year, everybody.
All right, welcome to a new episode of Opening Bid. I'm Yahoo Finance Executive Editor Brian Sozzi. Like I always say, this is the podcast that will make you a smarter investor. Really excited for our feature interview here at the Nasdaq for Opening Bid. That is former TD Ameritrade Chair and CEO Joe Moglia. I should also mention the former head football coach of Coastal Carolina. You've had many different hats. You've worn many hats. Thank you for joining us. We appreciate it.
I'm delighted to be here, Brian.
My instinct says I want to talk about stocks, but I got to start on football. What is it like to coach a football team?
Well, I get asked that quite a bit, actually. Which was more difficult or more challenging, more fun? My career on Wall Street or my career as a football coach. And I've loved them both. Both are challenging in their own ways, but there's nothing I've ever done that's more competitive than coaching football. Let's put that in perspective. Literally, the job is about 80 hours a week. It's for 5 months. There are 7 days a week. There are no days off, period. Unless maybe you have a bye week, then maybe you get 1 day. Your entire career is dependent upon whether or not you went on Saturday. Somehow, almost every male in this country can do 2 things really, really well. They know how to grill and they know how to call or run a football team. So if we don't win each week, our jobs are in jeopardy, and we will, not hesitate to get fired. Every job I've ever gotten in football, and frankly, many of them at Wall Street, because the previous person was let go. So while I've loved them both, there's nothing quite as intense as what in-season football is.
What is the secret to keeping it all together in these pressure-packed situations?
I think my leadership philosophy is something that I call BAM. It's, a real man, a real woman, a real leader. Now, BAM is be a man, but that's for football guys. But it's an acronym for leadership. And you stand on your own 2 feet, you take responsibility for yourself, you always treat others with dignity and respect, you live with the consequences of your actions. So keeping it together, it's part of your responsibility. You're responsible for the people around you. You're responsible for your audience. You're responsible for your clients. And you're the one that's got to be able to do that. So there are no excuses in that leadership philosophy. You got to get it done, and you got to know how to prioritize. You got to know how to delegate. And those are things actually that I've frankly been able to do pretty well over time. And I would say that philosophy has been my single most competitive advantage I've had over my 2 careers.
Winning in sports and in business, you have to figure out a way, I imagine, to get the most out of your team. Like, what are some of your motivational tactics that you have used to get people to, they might be tired on the field. Maybe they're out of gas, but somehow they find a way to run through a wall anyway.
All right, when I got to Coastal Carolina, there were 2 things we did that nobody else in the country did. Literally nobody else did. The one was we had no rules, none. Every football team.
No rules.
Right, none, 0. We had one standard. Guess what that was? BAM. So we have 120 guys that are players. You have another 25 male analysts, interns, coaches, et cetera. So be a man worked really, really well for our football program. But this is the same leadership philosophy I raised my daughters on. It's the same leadership philosophy I had in the business world. So it's an acronym for leadership. So again, a real man, a real woman, a real leader stands on their own 2 feet, takes responsibility for themselves. You always treat others with dignity and respect, and you live with the consequences of your actions. So no matter how tired you are, no matter how banged up your team may be, no matter how difficult your schedule is, no matter what your record is, no matter what's going on, snow, sleet, hail, it doesn't matter. Your job is to give that program your very, very best each and every day. By the way, not just on the field, but in the classroom, and everybody knows our guys, so the behavior on and off campus is a critical part of that. And everybody, one of our guys, somebody's son or somebody's brother. You got to live up to that. That carries over to the business world and private life and family.
You get me so fired up right now. I just want to drop and do 80 push-ups. This is I feel it. I feel your energy. I mean, but where did you grow up? Tell me a little about your story.
Well, before I do that, I would like to see you do 80.
No, I could. We'll do it. Let's do it at the end. I really could.
You're in shape.
I really got a hardcore working out. We'll take that offline, though.
I grew up in the Dyckman Street section of New York City, which is the northern tip of Manhattan on the Bronx border. It was a gang area when I grew up. My dad was born in Italy. He never finished 2nd grade. He came over here when he was 11. My mother was born in Ireland. She came over here and married my father. She never finished high school. 7 of us, I was the oldest of 5, grew up in a 2-bedroom, 1-bathroom apartment in Dyckman Street. And 2 of my best friends that I was with every day in grammar school, every day, got killed when I was in high school. One died of a drug overdose. The other was killed by the police robbing a liquor store. If I had not been playing high school football at Fordham Prep when I went to high school in the Bronx, I would have been with the guy robbing the liquor store. So for me, that's really how I grew up. And that was a pretty good wake-up call. And my goal was to play football and baseball in college. I wanted to do well academically, and then my girlfriend got pregnant. So for me, I had to give up sports. I decided whether or not I could go to college. Our family couldn't afford it. My father didn't want me to go to college. My father had a fruit and vegetable store. That's what he had. And I worked for him from the time I was 10 to the time I was 22. He just wanted me to go to the fruit store. I knew I kind of didn't want to go to the fruit store. When I told him, Dad, I got to go to college, he said, well, we don't have any money. I said, I'll figure that out. He said, son, you're making a big mistake. Now, I'm in a tough spot in my life, and I got my father telling me I'm making a big mistake going to college. So just quickly, my freshman year, I paid every dime of my education. I supported my wife and my daughter. I drove a yellow cab here in New York City. I drove a truck for the post office in Old Chelsea Station on 18th Street between 7th and 8th Avenue, and worked in my father's fruit store. That wasn't the most fun a freshman ever had in the history of college freshmen. It was the first year I didn't have sports. So my next year, Fordham Prep gave me a job coaching. So during the season, I coached high school ball. During the off season, I worked for my father in the fruit store, majored in economics, thought I wanted to go to Wall Street, but instead I wanted to go and coach.
How'd you end up going to Wall Street?
Well, that was later on. So I wound up coaching for 16 years. And it was my first year at Dartmouth, my 13th year coaching. We now have 4 children. I'm the defensive coordinator at Dartmouth in the Ivy League. Now, Dartmouth's in New Hampshire. It gets cold there. So my wife and I were going through a divorce, and I couldn't afford to live independently and take care of my family. So I got permission to move into a storage room above the football offices. So while it was an easy commute to work, it also had no heat. So I could see my breath in the wintertime. January 1984. So my goal was to be a head coach at a major school. And January 1984, Miami upsets Nebraska for the national championship. Mike Archer is the secondary coach. He gets the head job at LSU. They offer me the job to go take Archer's place, then ultimately succeed Tom Alvadati as defensive coordinator. So I'm going to go from defensive coordinator in the Ivy League to defensive coordinator for the national championship team. There was no more perfect job I could have had in my life than that job. But again, I talked a little bit about what a coach's life is like. There's no days off. There's 5 months. Back then, we didn't make any money. I've got 4 kids that's still going to live in New Hampshire. I'm going to live in Coral Gables. I can't afford to fly back and forth. Brian, the toughest career decision I've ever made, ever, was turning down the job. But I didn't think I could do my job as a coach if I couldn't live up to my responsibility as a father. And I always had an interest in Wall Street from college on the institutional side. And I still have my job at Dartmouth, but I did everything I could to hustle. And then eventually Merrill Lynch gave me a shot, and they put me in their MBA institutional training program. There were 26 of us, 25 MBAs from Harvard, Stanford, et cetera, and 1 football coach.
And the guy used to drive a cab.
Everybody wanted to short me.
Yeah.
Everybody wanted to short me. He said, this football guy's never going to make it here. But fortunately, that worked out.
I want to talk a little bit about the work you did at TD Ameritrade, but what do you think about Wall Street culture today? I mean, there's so much focus on how many hours young junior bankers are working and analysts. But I listened to your story. I mean, you're pretty successful. I mean, working those long hours seem to have paid off.
Well, I think working long hours is not necessarily the key. I think how productive and efficient you are within those hours, and understanding, we talked a little bit earlier about one of the skills a leader has to have is know how to prioritize. Well, that's true as an individual bond salesman. If I'm an associate investment banker, I'm going to be working 90 hours a week. Well, I've got to be able to prioritize my work so I can do it well. So at the end of the day, really, that whole time is really a job interview for you to be able to get promoted, wind up getting your own book and all of those things. But I think what it comes down to is, I go back to BAM again. Take responsibility for yourself. What do I need to do to excel at what I have to do? It's not a matter of putting in time, but if I can prioritize well and execute well, and that requires time to be able to do that, then I have no choice but to put in the time to do that.
Do you think Wall Street culture will ever change? Or it's always going to be that hard charging? If you want that big bonus, you want that big position, you're just going to have to work your ass off.
I think what's going to change is what we have going on now in blockchain technology, what we have going on in AI. The world is changing. To me, I think AI will be more significant than what the internet was back in the 90s. And I think this is still the early stages. So a lot will be changing. But at the end of the day, there's 2 things that matter. 1, what your career path is going to be. And 2, within that career path, if it's in the financial world, is how much money you're going to get paid. So my guess is the avenue to do the right thing and to do well in your career and to make some money, you still got to get the job done. It might be a different format or a different structure than what it was 10 years before that or 20 years before that, but the idea of doing well in your career and making money, greed, fear, all those things are part of that. They're not changing. They don't change.
Is there a leader on Wall Street that you look to that you think they continue to do a really good job, or a new one that we all should be on the lookout for?
Well, the ones that I've got a little bit, it's a little bit more the older breed. When I moved to Omaha to take over Ameritrade, I became good friends with Warren Buffett. I've certainly had tremendous respect for him. And the 2 people today that I have a lot of respect for and that I know, one very well, I know James Gorman at Morgan Stanley very well. We were colleagues
on the Disney
Merrill Lynch
board
together. Yes.
Yeah.
And he just stepped down. And the other one's Jamie Dimon. I mean, I think we're not good buddies, but we definitely know each other and have a lot of respect for him. I mean, those are three pretty solid people to be role models or be good examples, I think, of trying to do the things the right way, where the egos don't get in the way. Now, they all have egos. But when you make a mistake, you've got to be able to acknowledge you made a mistake. You've got to figure out why you made the mistake and what the problem is. And you may make another mistake, but you need to solve what the problem is, why you did that, and then be able to solve for that. And that's what all those guys do.
What'd you learn from Warren Buffett?
Yeah, I think for him, while Berkshire Hathaway is a major institution, at the end of the day, he runs money. That's what he does. And he loves stocks.
He loves investing.
Buying and selling stocks. So I think what I learned a little bit more from him is that we had multiple one-on-one dinners together, and he's very, very much a regular guy. He's really down to earth.
Do you get nervous for a meeting like that?
No, I was excited. I get excited for a game. I don't know if I get nervous. I think your adrenaline picks up a little bit, but it's an interesting story how we actually met, if you're interested.
Yeah, fire away.
Okay,
please.
so Liz Clayman, who's on CNBC at Fox Business at the time.
Good friend.
Yes, was also with me, was writing a book on investing. So she interviewed me for the book somewhere on Wall Street. So at the end of the interview, we had dinner. I asked her if she had interviewed Warren for the book. She said, "Oh no, Warren doesn't do interviews." I said, first of all, I'm sure he's a big fan. I had no idea if that was the case. Secondly, you're writing a book on investing. He's the #1 investor icon of the world. You got to call him. A week later, I get a call from Liz. Joe, I call Warren. He picks me up. He begins with, "I'm a big fan. How can I help?" She gets the interview. So at the end of the interview with him, she says, "Well, last week I interviewed Joe Mowgli. Oh, Joe's done a great job out here. Everybody loves him. Doing a great job at Ameritrade." He said, "Well, do you know Joe?" "No, I don't know Joe." "Would you like to get the research?" "Yeah, I'd love to." Yeah. So she wants to broker this trade. I said, "No, I'll make the call." So I make the call, and I take a couple deep breaths. I prepared ahead of time, and I said, "Warren," I said, "for the reason why I'm calling, 2 reasons why I'm calling. #1, I've lived in Omaha for 4 years. I run a firm that's headquartered in Nebraska. I own a home that's in Nebraska. I have a Nebraska
you came out hot.
license plate." I said, "So I consider myself a fellow Omahan and Nebraska." #1. #2, I could have looked Liz Clayman in the eyes if I didn't make this call myself. I wondered if you'd like to get together sometime. He said, "I'd love to. How about dinner?" That was it. That was it.
Awesome. Well, Joe Mowgli, hang with us. We're going to go off for a quick break. We'll be right back on Opening Bid. All right, welcome back to Opening Bid. Having a fascinating chat here with Joe Mowgli, our featured guest for this episode. Really, we're calling a fun chat, fun meeting with Warren Buffett. You mentioned, I want to get into markets and stuff, but you mentioned James Gorman. He's at Disney.
Yep.
Wow, what a big job trying to pick the next CEO of Disney. I mean, what does James Gorman bring to the table?
Well, I think he brings an ability. I think an excellent knowledge. I think he also has real common sense that, frankly, a lot of leaders don't necessarily have.
Right.
I think he's an excellent judge of talent. But I think for me, if you look at what he did at Morgan Stanley, he had a tremendous strategic approach to what's going on. A lot of people have good strategies, but can't necessarily execute those because they don't simplify them enough so that people can actually execute. James can do all that. And he's got a brilliant mind. He's got a great sense of humor and all those things. While his job at Disney is very, very important to hire the next CEO, that is no way near as tough of the job as he had as CEO of Morgan Stanley.
Yeah.
So while this is an important gig, this is an easy gig for him compared to what he's been doing the last 20
Well, he picked up for who? John Mack, right?
Yes, that's right.
Yeah,
that's right.
And Morgan
Yeah,
Stanley.
yeah.
I mean, it's important that Disney gets it right? I mean, this is
no question.
I mean,
but it's
critical.
important everybody gets it right. Right? Morgan Stanley needs to get it right. The New York Stock Exchange and Nasdaq need to get it right. Yahoo Finance needs to get it right. Right? So no, they got to get it right. But James will be very, very thoughtful on this, and I think he'll begin, I believe, with what are the skill sets that are really required for the next leader of Disney. What's the skill sets? And then when you start to look at people, you don't just leave this to a search firm. You spend real time doing due diligence on, does this person have the skill sets to be able to get this job done the way we need to get it done? That will then give you the final pool. That takes real work. That's why it will take a while to be able to do this. But then once you find the right person, you find the right person. But it takes tremendous due diligence to do this. And that'll be something he'll get involved with himself. He's not going to trust this to somebody else.
Sure. What do you think about the changing of the guard of Wall Street? Jamie Dimon, I mean, he's not going to be CEO forever, of course.
Well, he might. He says he won't, but I think there's a rolling like 2 years for him in terms of.
Yeah, he might. I mean, we have, of course, Ted Pick replacing James Gorman. Now, what do you make of this next generation?
Well, I think the next generation came up, as part of the generation with regard to the internet, the .com world, and with everybody's wired. So what we have access to in terms of information today is a multitude of what we would have had access to 20 years ago. But it's not this generation, Brian, and next generation. The generation evolves over time. So the one generation morphs into the other generation. It's not like all of a sudden we stop here and we got a brand new group. The next group that's ready to go, it's kind of like it's your junior year. What? Now you're going to your senior year. You're ready for your senior year. It's a little bit more of that type of transition.
I see. I go to Yahoo Finance and I see the awesome free plug for Yahoo Finance. All the amazing changes we've made to our platform in the past 2 years.
I commend you for all that.
Thank you. Trust me, it's a big team, and it's just definitely not just me. But vodcasts, I mean, new tools, everything seems to be moving faster. I mean, what's your outlook on the future of investing? Like, what changes should investors expect?
Oh, I think from my end, I think you got to begin with the president-elect. I mean, we have a president who's going to be president of Bitcoin. He loves business. He loves the markets. He wants to do well. He likes trade. I mean, he loves crypto. I mean, you can't do much better than that. He's hiring people in the cabinet. They're all pro-business, pro-crypto, pro-trading. He wants to deregulate. He wants to have lower taxes. Everything he's doing, everything, is kind of helps lay the base for a very, very, very solid, I believe, several years going forward. Now, what are the risks? I think the risks are more geopolitical than they are anything else. We never know exactly what's going to happen in the world.
Things pop out. You wake up in the morning, something pops out of some country.
Could be something horrible.
Sure.
So we don't know exactly what that is. And then I think when somebody is as aggressive as Trump and his people are going to be, that probably means you're going to make some mistakes. I think the key is how catastrophic might those mistakes be, and how quickly do you, again, eliminate your ego so you can solve for the problem and get those fixed. So I'm not saying it's going to be perfect, but I'm saying the probabilities of us doing very well over the span of the next few years is, I think, pretty significant.
So you think this is just what we're seeing in markets after the election? You think it's just a start? You think this run could really continue?
Yes. Well, for two reasons. One, because of the president and the whole philosophy and the people he's hiring, et cetera. And the second one is AI. I mean, the impact that AI is going to have on productivity in this country and the business world with regard to the markets, blockchain technology, all of these things going forward are only going to help us get better and improve. That doesn't mean there's not going to be hiccups. There's going to be hiccups. We're going to have growing pains. but we should pick ourselves up and kind of keep going.
Are you a guy worried about the deficit?
I am, but I think this is one of the things I remember talking to Warren about. He goes, look at the percentage of the deficit relative to our GDP. And as long as that's manageable, we're okay, because you can grow your way out of this. Now, having said that, we sure put a lot of extra money in the deficit over the span of the last several years. I like to think, though, besides his commitment to doing what he believes is the right thing for our country and the right thing for the markets, et cetera, he wants to cut costs. He wants to minimize regulation. He wants to minimize cost. So those things will help. Those things can help as we go forward. And if we do grow in our economy, and if we don't spend widely, and we're cutting costs, there's no reason why the deficit can't start to come under control. But that's a decade-long thing.
You mentioned we'll have a president of Bitcoin. I mean, what do you think it means for the broader stock market? Now we have we're going to have a bunch of really scores of investors potentially looking at a whole new asset class. I mean, crypto's gone through the roof since the election, don't get me wrong, but now we're going to have more competition for investor dollars.
But you have to be thoughtful, I think. If you're going to put money into the crypto world, probably Bitcoin is the number one spot to be able to put that. Now, there are other ways to do that. You can do it through Coinbase. You can do it a number of other ways. But I think I can appreciate what people thought the risk was several years ago. I mean, you got Jamie Dimon, who I just gave credit to for being one of our finest CEOs. You're calling these things pet rocks. Now JP Morgan will use use Bitcoin as collateral for loans. So the world really is changing as far as that goes. So I think if you're just simply invested in Bitcoin, and you can do that through, frankly, one of Kathy Wood's funds. You know, she's got ARC-B for Bitcoin, and it's very, very reasonably priced as far as fees go. You don't have to overly think about it. You just buy the ETF. But with deregulation and the swarm to the market with regard to crypto, and a president who wants the United States to be the leading crypto player in the globe, I'd say it's a pretty solid place to be. I'd say you almost cannot not be in it.
Is it, when you see I mean, it's crowded trades, Mag 7. I mean, it's like investors don't realize there's 500 other stocks or 493 other stocks to own. I mean, what do you think about investors piling into these 7 stocks, almost forgetting that valuation matters?
Well, they've been doing that the last few years. So this is not the first year that's happened, right? I think part of the reason why they're so big is because people have been piling into the stocks.
Well, I mean,
right?
Nvidia, Amazon.
Yeah, I mean, all 7 of them.
You ask some people what these companies even do. They probably have no idea. They're just buying them.
Well, I think people that don't do the homework probably have no idea in terms of what they do. But people, you know, one of the things, I had written a book on investing when I was at Ameritrade, primarily because our mission at Ameritrade was to bring financial literacy to every family.
It was the first platform that I bought my first stock. I still remember. I've said that's no BS.
Good job.
I'm not telling you that because you're here. I still remember the black screen, and I'm like, wow, this is cool. I bought shares of Starbucks. I bought 5 shares of Starbucks. Yeah.
They turned out okay.
Yeah, I did. Well, I don't have them anymore. I'm just saying, but I mean, it was an exciting time.
Well, our mission was, most of the time you hear somebody's mission say, oh, we want to be the firm of choice. That's crap. Just ours was, we wanted it to be aspirational. We wanted to be about our clients. So we want to bring financial literacy to every family in this country. So one of the points that I made in the book was, the reason why I wrote the book, this is not that difficult. Wall Street makes it difficult. We use a lot of terminology that people don't necessarily understand, but it's not that difficult once you take some time to understand it. And the typical family in this country, and this really bothers me, spends more time planning a vacation than they do managing the finances. And managing your finances is really pretty important. So I want to hope I hope everybody's involved with the market somehow, because if you're involved with the equity market in the United States, you're probably going to do well over time, even if you don't know what you're doing. I'd like to hope that more and more people are doing a reasonable job of having at least a basic understanding of what it means when they actually buy a stock.
In the last couple minutes we have, we always like to ask our guests for hot takes. So I'm going to ask you for 2 of them, if you don't mind. What do you think about what Robinhood's doing? They've morphed into a totally different platform. Actually, they have won our Comeback of the Year award. Acquisitions, better run. A lot of people have been surprised.
Well, I think you've already answered that. So first of all, they won your Comeback of the Year award.
Yeah.
That's a pretty good step in the right direction. Yeah. Remember when they were blowing up, a few years ago, I was asked a lot of times in the business media, well, you know, what was my perspective on that? And I said they've got to do 2 things. They've got to diversify and they got to fortify. So they got to diversify the products, et cetera, et cetera. They were too reliant on the money you get when you do a trade.
Yeah. Payment for order flow.
Yeah. They're too reliant on that, and they didn't have enough substance on the balance sheet. And give credit to their leaders, they've done a good job of fixing that over time. So a few years ago, frankly, if I thought about investing, especially when I look at Ameritrade and we look at our client assets or Schwab, our client assets versus what their client assets were, that's not something I would have gotten involved with. I think with what the job they've done over the span of the last year or two, that would be a stock, it would be a company that I would invest in. They've come a long, long way, and I think they deserve comeback of the year.
Appreciate it. And then last but not least, your advice to the next generation of traders.
You mean by traders? You're talking about day traders?
Traders in general. Yeah.
I think you got to recognize that the world is changing before our eyes. So you've got to be on top of that as the world changes. You can't just if you go back a little bit when the internet happened and we started to have electronic trading. Well, there were a lot of traders that had full-time jobs in the New York Stock Exchange who didn't have their jobs later on. Don't fight the trend. Adapt and adjust with the trend. But I think at the end of the day, this is about you doing the very, very best job you can in your particular area. What is your competitive advantage? How do you lever that into what's your core competency? How do you lever that into competitive advantage so you can be a leader in the area that you choose to participate in or compete in? And that would be my advice.
Well, I would say this: spending 24 minutes with you, I could tell why football players would run through a ball.
I'm still waiting for the 80 push-up.
You still got it. Joe Moglia, a real treat to spend some time with you. Look forward to staying in touch, and happy holidays.
Happy holidays to you as well, Brian.
Thank you.
Thank you.
All right, that's it for the latest episode of Opening Bid. Be sure to hit us with those likes or thumbs up on YouTube, Spotify, and Apple Music. We appreciate the love, and we'll talk to you soon.